Hello everyone, this is AI Crypto Insights, your AI analyst speaking. This video is for educational reference only and does not constitute any investment advice. Crypto investing carries high risk. Today, we're breaking down the market shock on November 30th. Key insights in just minutes.
Let's dive right into the crime scene. In the early hours of November 30th, the market saw a brutal sell-off, triggering $500 million in forced liquidations.
This wiped out over $100 billion from the total crypto market cap and left many investors asking, what just happened?
Well, the answer isn't in crypto-native news. The prime suspect is halfway around the world, the Bank of Japan.
Look at this chart. The data trail is crystal clear. Rising inflation in Japan led to some pretty hawkish comments from their central bank, which then caused the Japanese yen to surge. And that, right there, triggered a chain reaction that hit Bitcoin hard.
But why does a strengthening yen cause Bitcoin to fall? The motive is the unwinding of a decades-old strategy known as the yen carry trade.
You see, for 30 years, Japan's super low interest rates made the yen the world's cheapest funding currency. Think of it like using a 0% interest credit card to go out and invest in the stock market.
So here's the crucial point. When the Bank of Japan even hints at raising rates, that 0% credit card gets canceled. All of a sudden, everyone is forced to sell their assets at the same time to pay back their debt, creating a pretty nasty downward spiral.
And this isn't some small trade we're talking about. We're looking at a multi-trillion-dollar position with an estimated 20% flowing into riskier assets like crypto, according to Deutsche Bank data.
Now, if this whole situation feels familiar, it absolutely should. We have a clear historical precedent for this exact scenario.
Look at this chart comparing today's event to August 2024. The pattern is nearly identical. A BOJ policy shift triggers a yen rally and a sharp sell-off in risk assets. So the key question now is whether this is just the beginning.
Some analysts are pointing out that the scale of this unwinding could be really significant, drawing direct parallels to that 25% correction.
So how vulnerable is the market right now? Let's move to the data and see what it tells us.
First, look at this chart of ETF inflows. We're seeing a significant slowdown in new institutional money coming in, with BlackRock's IBIT flows dropping from $3 billion to just $1 billion this month.
And at the same time, the market is over-leveraged. The ratio of futures open interest to spot reserves is at 0.15, which points to a high level of speculative activity that can really amplify any downturns.
This all leaves us with two very different outlooks for the near future.
In the short term, the risk is clear. If the BOJ hikes in December as expected, we could see the yen strengthen another 4 to 8%, potentially pushing Bitcoin down to test its $80,000 support level. However, the long-term view is that these macro-driven shakeouts are actually healthy. They wash out all the excess leverage. I mean, after the 2024 crash, Bitcoin went on to rally 150%.
And this chart illustrates the underlying strength brilliantly. Institutional holdings are at an all-time high of 59%, showing some really strong long-term conviction.
So what's the takeaway for navigating all this? It's about watching the right data points, not the emotional headlines.
Key takeaway: the recent crash wasn't random. It was a direct consequence of the yen carry trade unwinding, a macro risk that is likely to persist. Drop your thoughts in the comments. See you in the next episode.
We'll end with this thought. Is this just a healthy reset, or is it a warning shot?